Welcome everyone to KPMG's Accounting and Reporting webinar series. What's new for 30 June 2021 reporting? I would now like to hand over to your host, Kim Heng. Kim, over to you.
Thank you. I'm Kim Heng, your host for today's webinar. I'm a partner in our Department of Professional Practice, a group that helps clients and KPMG staff with interpreting and applying IFRSs and other financial reporting requirements. Joining me on this webinar is Hayley Pang and Kristen Haynes, both senior managers, and Oksana Klichenko, a manager within the team. It has been over a year now since COVID-19 was declared a global pandemic. There continues to be uncertainty in the economic markets, both locally and globally, and the Australian borders are yet to reopen, presenting a significant challenge for certain industries. ASIC remains focused on its various surveillance activities, and like many other stakeholders, is focused on how companies have been impacted by COVID-19, specifically how this has been addressed and disclosed in the financial report and operating and financial review, otherwise known as the OFR. Stakeholders are increasingly demanding more from the financial statements and the OFR, and this is not limited to the uncertainty introduced by COVID-19. Another hot topic for investors is the impact of climate change as business models are increasingly exposed to social and environmental issues. Switching gears to the accounting standards, the local and international standard setters continue to be active, working on amendments to the standards and interpreting through IFRIC agenda decisions how standards should be applied to common transactions. With this all in mind, let's look at our agenda for today. In today's webinar, Kristen will discuss the new accounting standards effective for the first time this June. Kristen and Oksana will take us through some of the recent IFRIC agenda decisions. Hayley will share what our regulators are concerned about and some topical issues worth thinking about this June. Oksana will then provide us with a short update on Australian reporting issues. And then I'll wrap up and we'll all respond to your questions. If you have any questions, then please submit them using the Q&A function, and we will try to address as many of them as possible at the end of the webinar. If we do not get to your specific questions, then we will answer them through your usual KPMG contact separately following today. Next week, we'll be uploading both the recording of this webinar and the slides to our external website where you'll be able to access them. I'll now hand you over to Kristen.
Thanks, Kim. There are a number of accounting standards which are newly effective for 30 June 2021 year ends. We have discussed a number of them in our December webinar, so I don't intend to discuss all of them in detail today. Please refer back to that last webinar recording if you do want a refresher on the details. However, there are two amendments I would like to cover today as we believe that they may have a broad impact. Firstly, the accounting impacts of the reform of interbank offer rates, or IBOR, the benchmark interest rate that underpins many financial instruments. The IASB has a two-phased approach to grant accounting relief related to IBOR reform, and I will cover these shortly. Secondly, the COVID-19 related rent concession amendments is effective for annual reporting periods beginning on or after 1 June 2020, although we expect many June year ends have already early adopted it. It's important to highlight for the COVID-19 related rent concession, practically expedient, it was extended by 12 months by additional amendments that we will also cover. There are two new standards effective for June half years. Phase 2 of the IBOR reform amendments and the COVID-19 related rent concession amendment. So what is this IBOR reform? Fundamentally, what is happening is that a number of benchmark rates around the world are changing, and these changes are not limited to the countries on the screen, but also extend to other countries across Asia and Europe, including Japan and Hong Kong. Thankfully, the BBSW in Australia and the BKBM in New Zealand are not currently affected, which is perhaps why it has not been the focus of Australian companies. However, we do need to start paying attention to it. The transition period to these new rates raises challenges both with forecasting the appropriate rates, and for many contracts, unless they were entered into since IBOR reform has commenced, may not have contemplated any mechanism for changing the rates. Therefore, if you have debt, hedges, leases, or other contracts with any links to interest rates in a currency impacted by the benchmark reform, you are going to need to deal with this reform. The IASB has acknowledged that IBOR reform is causing issues and has introduced amendments to assist organisations in dealing with it. Firstly, the Phase 1 amendments. This is applicable for 30 June 2021 year ends for the first time and should already have been adopted by 31 December reporters. This first phase is about dealing with the uncertainty that arises from IBOR reform. It has minimal financial reporting impacts, but effectively just allows hedge accounting to continue even if there is uncertainty about the existence of future cash flows as a result of the changing benchmarks. That is, if you're hedging LIBOR out for the next 10 years, even though you know you will not have LIBOR cash flows out that far, as at some point it will need to change to the new benchmark, you cannot at the moment ignore that uncertainty and continue to assume that there will be LIBOR cash flows and continue to apply hedge accounting. As there is so much uncertainty around the IBOR reform, the IASB is of course also requiring additional disclosures. The Phase 2 amendments deal with issues associated with changing interest rates in contracts. These amendments are newly applicable for this June half years and are available for early adoption for June year ends. It introduces practical expedients to allow for sensible outcomes in transitioning to the new benchmark rates. Firstly, under AASB 9, the Financial Instrument Standard, changing interest rates can cause significant gains or losses in the P&L. Therefore, these amendments allow organisations, when changing interest rates to an economically equivalent rate, to simply update the effective interest rate and avoid the P&L impact. A similar practical expedient is also introduced to AASB 16 for lessees who have to modify their leases as a result of the reform. In hedging, there have been a number of minor amendments to facilitate the swapping of rates, made more complicated as both the hedged item and hedging instrument need to be updated. One of the changes is that the IASB has said that hedging documentation can be updated for changes in rates due to IBOR reform without having to discontinue hedge accounting. And again, more disclosures are also required. Kim, have you got any insight as to how other countries who are more closely involved in IBOR reform have been coping with these amendments?
Thanks, Kristen. You have made those amendments sound quite simple, but unfortunately, we are hearing practical application is more complex. We're hearing from our colleagues overseas that there is devil in the details, and significant issues can arise when trying to put this into practice. Accordingly, we would highly encourage all of you that are impacted to start thinking about this now, especially those of you with hedges in impacted currencies, as this is where the majority of the issues are arising.
Thanks for that, Kim. Let's now have a look at standards available for early adoption. As you can see, there are several. We don't plan on touching on all of them today, but just wanted to highlight a couple. Amendments requiring a liability to be classified as current when companies do not have a substantive right to defer settlement at the end of the reporting period is effective for annual reporting periods commencing on or after 1 January 2023. These amendments were further clarified by an IFRIC tentative agenda decision, which Oksana will cover in the next section. There has also been 2 new pronouncements since our last webinar. In February, the IASB introduced a new definition for accounting estimates and also clarified several aspects of the application of materiality to disclosures of accounting policies by amending IAS 8 and IAS 1, respectively. Now let's have a closer look at 2 other standards that are also available for early adoption that we think could present more of a significant change for some of you. The first one to highlight is COVID-19 related rent concessions beyond 30 June 2021. This is effective for annual reporting periods beginning on or after 1 April 2021. It provides a 1-year extension to the previous COVID-19 related rent concessions amendments that were issued last year. The 2020 amendments introduced an optional practical expedient that allows the lessee to account for a COVID-19 related rent concession as part of the existing lease contract and not need to apply lease modification accounting. However, The amendment only applied to rent concessions for which reductions in lease payments only affected lease payments due on or before 30 June 2021. As the economic challenges presented by COVID have persisted longer than initially anticipated, the Board has extended the practical expedient by 12 months, permitting lessees to apply it to rent concessions for which reductions in lease payments were originally due on or before 30 June 2022. The original version of the practical expedient was and remains optional. However, the extension may in effect not be optional. Let's have a look at an example on the next slide. Due to the impact of COVID-19 on the lessee's business, a lessor has agreed to reduce lease payments for a head office lease until 30 June 2021 and for a regional office lease even further until 30 June 2022. When preparing the 30 June 2020 accounts, the lessee early adopted the 2020 amendments. The rent concession for the head office lease met the payments due eligibility criteria, so the lessee chose to apply the optional practical expedient. As the reduction in lease payments for the regional office goes beyond 30 June 2021, the lessee instead applied the lease modification accounting to that lease. Moving on to 30 June 2021, the lessee decides to early adopt the 2021 amendments. Under the 2021 amendments, the lessee will be required to consistently apply the practical expedient extension to eligible contracts with similar characteristics and in similar circumstances. This means it will need to reverse the previous lease modification accounting for the regional office lease because the rent concession for the period from 1 July 2021 till 30 June 2022 was previously ineligible for the original practical expedient, but became eligible as a result of the extension. Accordingly, if you have any rent concessions that go beyond 30 June 2021, and especially if you are applying the original practical expedient for the first time at 30 June 2021, we encourage you to early adopt the 2021 amendments to avoid complications in the next reporting period. The final standard available for early adoption is insurance contracts. An insurance contract is a contract under which one party accepts significant insurance risk from another party by agreeing to compensate the policyholder if a specified uncertain future event adversely affects the policyholder. Some of you may be thinking that the new insurance contract standard, AASB 17, only applies to insurers and wondering why we're talking about it today. However, the standard actually applies to contracts, regardless of the organisation that issues the contract. As this standard applies to contracts, corporate organisations that are not insurers may also be impacted. Today we'll look at the scope of the new standard. We will highlight the scope exemptions and also some common contracts that non-insurers might enter into that could be insurance contracts. Although AASB 17 is applied for annual reporting periods beginning on or after 1 January 2023, the standard will be applied retrospectively with restatement of the comparative period. That is, effectively from 1 January 2022 for calendar year ends. This means if you are a December reporter, you will be required to disclose the potential transition impact of this standard in your financial statements this coming December. So now is the time to start thinking about if and how the new insurance contract standard may impact you. The definition of an insurance contract can be broken up into 4 steps. The first question is similar to what we ask under the Revenue and Leases standard. Is there a contract? A contract is an agreement between 2 or more parties that create enforceable rights and obligations. They can be written, oral, or implied by an organisation's customary business practice. The second step requires us to determine whether the arrangement will compensate the policyholder for a specified uncertain future event. This compensation could be cash payment or in payment in kind. For example, repairing or replacing a broken product. The future event for which the policyholder is being compensated is required to be uncertain at the inception of the contract. This uncertainty surrounding the event is the essence of the insurance contract. For the third step, a specified uncertain event needs to adversely affect the policyholder. For example, a policy that compensates a building owner for flood damage would meet this criterion because the building owner would otherwise be adversely affected by the damage. However, a weather derivative contract, where an organisation will receive payments if there is a flood, would not meet this criterion because the contract does not require the flood to damage their building in order to receive payment. Lastly, you need to consider if the issuer has accepted significant insurance risk from the policyholder. Insurance risk is any risk other than financial risk. It is considered significant if the issuer may have to pay significantly more out than it received if the uncertain future event occurs. Let's put this into practice with an example that may be relevant to service providers. A company provides a maintenance contract where they agree to repair specified equipment after any malfunctions. The fixed service fee is based on the expected number of malfunctions for the customer-specific equipment. The potential cost to repair the specific equipment could exceed the fixed service fee received in some circumstances. Let's work through the steps to assess whether this contract is an insurance contract. Firstly, under the terms of the contract, the company will compensate the customer for the malfunction of the specified equipment by repairing it. The uncertain event is whether the equipment will malfunction. In the event that the equipment did malfunction, this would have an adverse effect on the customer. The risk that the equipment will malfunction is not a financial risk, it is an insurance risk. And the company has accepted significant insurance risk as the cost to repair the equipment could exceed the fixed service fee received. Therefore, this contract does meet the definition of an insurance contract. Alternatively, a maintenance contract may not have fixed fees, but instead the fee may vary based on the amount of maintenance performed. Such a contract would not be an insurance contract as the maintenance company is not taking on a significant insurance risk. AASB 17 does have a number of scope exemptions. These cover various common contracts that a non-insurer might enter into. There are both optional exemptions and arrangements which are specifically scoped out of the insurance standard. The optional exemptions allow the organisation to choose whether they apply AASB 17 or AASB 9 to financial guarantee contracts and contracts that limit compensation. Similarly, there is a choice to apply AASB 15, the revenue standard, to fixed fee contracts that meet certain criteria. So, could our maintenance contract example be accounted for under the revenue standard using this optional exemption? One of the three criteria required to be met to apply the exemption is that the organisation does not reflect the assessment of risk associated with an individual customer in setting the price of the contract. In our example, the price of the contract was based on the assessment of the customer's specific equipment and the risk of it needing repairs. As such, the optional exemption could not be applied and this contract would need to be accounted for as an insurance contract. Some common fixed fees contracts, which may be insurance contracts, include roadside assistance, phone screen repairs, and extended warranties. Of course, whether or not they are will depend on the terms and conditions of each individual contract. Surety bonds may also be insurance contracts. For example, a parent provides a surety bond to its construction subsidiary that it will cover any defaults by its subcontractors on the construction of a new building. This is an insurance contract for the parent. Surety bonds can go by other names and are common in the building and construction, mining, engineering, manufacturing, and transportation industries. That was a very high-level summary of the scope of the new insurance contract standard. However, the key takeaway here is that even if you are not an insurance provider, you may be impacted. You will need to consider whether you are in the scope of the new standard, and if you are, understand how to account for insurance contracts applying AASB 17 ahead of the transition date. For more information on the new insurance contract standard, please refer to our KPMG First Impressions Guide available on our website or speak to your KPMG advisor. Looking ahead, the ISB has finalised deliberations on an amendment to IAS 12, which is expected to be issued shortly. This amendment will require organisations to recognise temporary differences on particular transactions where a recognition exemption was previously allowed. Watch out for the KPMG publication on this topic, which is coming soon. Let's now move on to the IFRS Interpretation Committee agenda decisions. There were 3 important agenda decisions discussed by IFRIC since our November webinar. 2 have been finalised and 1 tentative. We'll discuss each of these in turn. Please remember that these agenda decisions have the same authority as a standard. The first is a finalised agenda decision on supply chain financing in the books of the customer. Under supply chain financing, once the supplier has supplied goods or services to the customer, the financier pays the supplier upfront and collects from the customer at a later date. Such an arrangement is presented as a liability on the balance sheet of the customer, and the question is, what sort of liability is it? We did discuss this with you last year, and the IFRIC agenda decision was principally in line with what we discussed then. Firstly, when presenting this on the balance sheet, organisations should consider whether the nature or amount of the liability subject to supplier financing is different to that of their other trade payables and therefore would warrant separate presentation on the face of the balance sheet. Secondly, and this is a slight change from what we have discussed previously, assuming that the initial payment does not flow through the customer organisation, which is typically the way these arrangements are structured, then there would only be a single cash outflow to the financier shown in the cash flow statement. This cash flow is classified as either operating or financing, depending on the nature of the liability on the balance sheet. Disclosures will then also be required around the non-cash financing transaction when the financier pays the supplier, which creates the liability initially. Previously, we had mentioned that there was a choice to present the cash flows on a gross basis, but the IFRIC agenda decision has made it clear that net is the only acceptable treatment. Finally, in the notes to the financial statements, the use of supplier financing arrangements should be included in the financial risk management disclosures, including details around its existence and inclusion in the liquidity risk management disclosures, amongst others. I will now hand over to Oksana to discuss the remaining IFRIC agenda decisions.
Thanks, Christian. Moving on to the cloud computing arrangements. Cloud computing arrangements are ones in which a customer does not have possession of the underlying software. Rather, the customer accesses and uses the software on an as-needed basis, for example, over the internet. To date, IFRS standards do not contain explicit guidance on a customer's accounting for cloud computing arrangements. Instead, there is an existing guidance in ISB 138 Intangible Assets, and there have been 2 finalized IFRIC agenda decisions. Today, we will cover the 2021 IFRIC agenda decision in more detail. This agenda decision discusses a cloud computing arrangement that does not provide the customer with an intangible asset and does not contain a lease, and so it is accounted for as a service contract. In such an arrangement, IFRIC agenda decision clarifies the timing of expense recognition in relation to configuration or customization costs incurred by a customer in particular. It is important to note that this agenda decision does not cover any other services that a customer may receive in such contracts, for example, data conversion or training costs. If you would like to know more about accounting of other costs, or need a refresher on accounting for cloud computing arrangements more broadly, we recommend referring to our reporting update, which we have noted on a slide and which is available on our website. In the fact pattern presented in the agenda decision, a customer enters into a software as a service arrangement or a SaaS arrangement, which provides the customer with the right to receive access to software, however, does not provide a software asset itself. In addition, the customer incurs upfront costs of configuring or customizing the supplier's application software. The first issue to consider is whether a customer can recognize an intangible asset under the ISB 138 in relation to configuration or customization of the application software. To answer the first question, IFRIC observed that the customer does not have control over the application software and cannot recognize an intangible asset applying ISB 138. As the configuration and customization activities do not create a resource controlled by the customer that is separate from the software, a customer cannot capitalize such costs as an intangible asset either. However, if an organization pays for a service in advance, then it recognizes a prepayment asset. Conversely, an accrued expense should be recognized if an organization receives a service in advance of paying for it. So, how does the customer account for the configuration or customization costs? The IFRIC agenda decision observed that for a fact pattern where a third-party supplier provides the configuration or customization services, the customer applies a guidance in paragraph 69A of ISB 138 and recognizes the costs as an expense when the supplier configures or customizes the application software. However, where the supplier of the application software also provides the service, then ISB 138 does not directly cover the time period for recognition of those services. The agenda decision clarifies that in this case, the guidance in ISB 15 revenue standard, which normally applies directly to the supplier, should also be used by a customer to determine the timing for cost recognition. If the configuration or customization services are distinct in the context of a SaaS arrangement, the customer recognizes the costs as an expense when the supplier configures or customizes the application software. In contrast, if the additional services the customer receives are not distinct, the customer recognizes the costs as an expense when the supplier provides access to the application software over the contract term. So in this case, the upfront payment for customization or configuration services would be capitalized as a prepayment and expensed over the term of the SaaS arrangement. The distinct test will be paramount when identifying which services are separate from the supplier's overall promise in a SaaS arrangement and whether amounts are expensed or capitalized. Let's have a closer look into the guidance in ISB 15. A service is distinct if it is capable of being distinct and it is distinct within the context of the contract. The assessment will be based on specific facts and circumstances. However, I will make some general observations. A service is capable of being distinct when a customer can benefit from the service on its own or together with other readily available resources. In assessing these criteria, we would consider the base SaaS application as an other resource available to the customer. Therefore, the customer may be able to benefit from the configuration or customization service together with services already obtained under the base SaaS contract, and as such, these services will likely meet the first criteria in a distinct test. Then, we need to consider the second criteria, and this will be the harder test to apply. The standard provides some factors to help identify whether a promise to transfer a service is distinct within the context of the contract, which are listed on a slide. Let's focus on the middle one, as I think this may be the key for the assessment in this fact pattern. For service to be distinct, it should not significantly modify or customize another good or service in the contract. If the customization service requires the supplier to significantly modify the software, then a customer might conclude that the promises to transfer the software and the customization service are not distinct within the context of the contract. However,
conclusion could be different in a case when a supplier provides configuration services. So the ISB 15 guidance should be carefully analyzed by organizations. Kim, what are some of the practical challenges with implementing this agenda decision this 30 June 2021?
Oksana, I have heard from clients that the need to retrospectively apply this agenda decision will be difficult, especially for organizations with significant projects over the last 5 years, which is usually the economic life of these types of costs. It will be very time consuming to analyze all the costs. I heard a number like 10,000 line items incurred in implementing the SaaS arrangement to determine which ones should be expensed and which ones should be capitalized. And it may be difficult to get all of this done by the time the accounts need to be lodged. Therefore, if you have had SaaS arrangements with significant implementation costs, then you may need to get started on your analysis sooner rather than later. If you do not expect to get this analysis completed by the time your accounts need to be lodged, then you should have that conversation with your auditors. Now back to you, Oksana, to discuss the last IFRIC agenda decision for today.
Thanks, Kim. The next thing I wanted to tell you about was the tentative agenda decision on the classification of debt with covenant as current or non-current. Before I get into the detail on this, I should first remind you about amendments made to ISB 101. These amendments clarify that the classification of liabilities should be based on rights to defer settlement by at least 12 months that are in existence at the end of the reporting period. A right to defer exists only if the company complies with conditions specified in the loan agreement at the end of the reporting period, even if the lender does not test compliance until a later date. In its recent agenda decision, the IFRIC further clarified that when the right to defer settlement for at least 12 months is subject to future conditions related to financial position, a borrower would need to perform a hypothetical test for compliance at the reporting date, even if the loan agreement requires the test at a later date only. Whilst IFRIC discusses 3 case studies to illustrate a practical application of these amendments, we want to look at one of them in particular, as we think it is the most problematic for Australian organizations and will give you a flavor for the IFRIC's view of how the amendments should be applied. In this case study, an entity has a 31st December 20x1 reporting date. The loan requires a working capital ratio above 1 at each 30 June, so the ratio is tested only once a year at 30 June. If the ratio is not met on a testing date, the loan becomes repayable on demand. The working capital ratio at reporting date is 0.9, and it is expected that the working capital ratio will be above 1 at 30 June 20x2. When the test is required by the loan agreement. IFRIC observed that in this fact pattern, the entity assesses if it complies with the future conditions at the reporting date, being 31st December 20x1, even though the test is not contractually required until 30 June 20x2, meaning the company must perform a hypothetical compliance test at the reporting date. As the working capital ratio is 0.9 at reporting date, the company fails the hypothetical compliance test, and it does not have the right to defer settlement for at least 12 months. Hence, liability should be classified as current. Kim, I think it's fair to say that this tentative agenda decision caused lots of concern from different organizations. Do you have any insights to share on this?
Oksana, the board's amendment tries to provide a very simple test to reduce diversity in practice. However, there's been a lot of concerns expressed in the comment letters to the tentative agenda decision. A couple that I wanted to highlight that many people really are really worried about the use of a hypothetical test, which means that how a debt is classified for accounting purposes at the reporting date may not reflect the contractual rights and obligations of the parties involved. Additionally, specific loan agreements may consider the seasonality of an organization's business or the different stages of a company's operations, and therefore require compliance with different conditions at different dates. However, the use of this hypothetical test means that all of this will be ignored. In the recent IFRIC meeting that was held at the end of April, IFRIC agreed not to finalise the tentative agenda decision and to report back to the ISB the additional information that was raised by the various stakeholders in the comment letter. However, the IFRIC did confirm that their technical basis for arriving at their tentative agenda decision has been confirmed, and from IFRIC's perspective, just because the agenda decision is going back to the board for further consideration, from their perspective, the application based on the agenda decision is how the standard should be applied, and it should not be ignored. So therefore, we do encourage you to watch out for updates on this topic and to keep up to date with it in the lead up to the effective date in 2023. I'll now hand you over to Hayley, who's going to take you through some hot topics.
Thanks, Kim. As the demand for sustainability information continues to grow, locally, key financial regulators and standard setters have all issued guidance emphasising the importance of considering climate change, not just as a matter of corporate sustainability, but in the preparation of annual reports. Momentum for sustainability reporting has also been growing in other jurisdictions. Amongst others, the UK and US regulators are increasing their focus and actively introducing increased reporting on climate risks. Whilst many organisations may be in the early stages of their climate journey and grappling with some of their responses and how these translate into the director's report and financial statements, this is an area that is no longer 20 to 50 years away. We are likely to have to deal with it in our lifetimes and in not too distant forecasts. How this all gets factored in will continue to develop, and we expect quite rapidly. Climate-related risks are risks resulting from the impacts of climate change. In 2017, the first substantial guidance on climate risk to the financial sector came from the Task Force on Climate-Related Financial Disclosures, TCFD, which was set up by the G20 Financial Stability Board. The TCFD identified a list of business sectors most likely to be affected by climate risks. We expect every organisation to be impacted to some extent by climate-related risks, some more directly than others, so this should not be used as an exhaustive list of impacted sectors. There is a growing trend and stakeholder expectation in Australia to include reporting on climate-related matters, including opportunities and risks, in the Director's Report. Typically, directors include these climate-related risk disclosures within the Operating and Financial Review, the OFR, and the key topics of discussion include how climate-related risk impacts the business model, risk management, strategy, performance and outlook of the business, and governance. Moving to the financial report, organisations will need to consider how climate-related risks impact the amounts recognised and disclosures. There is no dedicated accounting standard for climate-related risks. There may be a lot of uncertainties when it comes to considering the impacts of climate on the recognition and measurement of assets and liabilities. As a result, organisations will have to use judgment and make assumptions to estimate the financial impacts of these risks, applying the requirements of existing accounting standards. Once the specific climate risks an organisation is exposed to and the potential consequences on performance identified, we need to apply a materiality lens by asking two key questions. Are these risks and potential impacts material?
would they be expected to influence the decisions of users on the financial statements? On this slide, we highlight some of the key areas in the financial statements where climate risk may have an impact. We won't cover these all in detail, but to highlight a few. Impairment of non-financial assets. There are a number of ways in which climate-related risks may impact impairment testing. For example, the impact of climate risks on forecast sales prices, customer demand, and operating and maintenance costs may be indicators of impairment, triggering the requirement to perform an impairment test. Climate-related uncertainties may also impact recoverable amount cash flows and discount rate. Some impacts may be quite obvious. For example, the destruction of a manufacturing plant or crop due to bushfires. However, consideration of government-imposed carbon taxes and levies, as well as carbon price assumptions relating to the cost of operating in a carbon-constrained world, may be more complex. For some organisations, the expected impact of climate risk may not yet be a material assumption. However, this should continue to be monitored. Turning to going concern, in addition to the cash flow uncertainties just discussed, which equally apply to going concern forecasts, the extent to which an organisation is exposed to climate risks may impact its ability to maintain or obtain funding to enable it to continue meeting its obligations. Financial regulators and banks are increasingly focused on minimising their exposure to climate-related risk and are active in creating initiatives to address climate risk. For example, some banks have announced thermal coal screening policies which put an end date on lending to organisations which specialise in producing thermal coal. Organisations in impacted sectors need to critically evaluate and reflect in cash flow forecast their expectations of the cost of borrowing funds in the future and any barriers in obtaining funding arising from announced or reasonably expected climate risk management strategies of lenders. For further information on how climate risk impacts the financial statements, including the remaining areas shown on the slide which we haven't had time to cover today, please refer to our reporting update on climate-related risks in financial statements available on our website, and watch out for future webinars in this space. Moving away from climate, some of you may be aware that in March this year, new legislation was passed which introduced a statutory definition of casual employee and granted courts the right to offset identifiable casual loading paid against leave obligations. This followed a judgment in May 2020 on the Workpac versus Rosato case, where it was ruled that an employee previously considered by their employer as casual worked regular and predictable shifts and was therefore entitled to certain leave obligations of a permanent employment. At that time, it was also ruled that leave obligations could not be offset against casual loading paid. This ruling set a precedent and resulted in a number of organisations reconsidering whether their casual employment arrangements would in fact be considered casual. In their 30 June 2020 reporting, many organisations recognised provisions or disclosed contingent liabilities for leave obligations for employees previously considered casual. The new legislation from March this year means that the assessment of casual employment arrangements made last June needs to be revisited. The new legislation has the potential to reduce or extinguish previously recognised liabilities, resulting in a gain in the profit or loss for the year ended 30 June 2021. So what does an organisation need to consider ahead of 30 June? The legislation applies retrospectively. As such, organisations will need to assess existing and past casual employment arrangements against the new statutory definition of casual. This assessment is based purely on the terms of the employment contract. Under the new legislation, a casual employee accepts an offer of employment where the employer makes no firm advance commitment to continuing and indefinite work according to an agreed pattern of work for the person. The assessment is based on the exhaustive factors shown on the left-hand side of this slide.
If the employment meets the definition of casual, any previously recognised provisions are reversed and again recognised in the profit or loss. If it is not clear that the employee is casual, then the organisation assesses whether the employee has been paid casual loading. If the organisation can identify the casual loading and the leave entitlements it is compensating for are clear, the organisation should consider derecognising the provision and disclosing a contingent liability if an organisation considers it is likely that a court would grant the right to offset casual loading paid against leave obligations. There may be judgment involved in assessing employment arrangements against the new legislation. Organisations should consider getting legal advice in making this assessment. It should also be noted that whilst this legislation is applied retrospectively, there is ongoing debate over the legality of retrospective legislation, so watch this space for possible future developments. Kim, I think it's fair to say that there have been a few headlines in the media over the past 12 months relating to remuneration reporting.
Oh, definitely, Hayley. The past 12 months has seen an increased focus on executive remuneration, with the number of companies receiving first strikes against the remuneration report. The cause of this dissatisfaction have been driven by a number of different factors. Some have been company-specific issues relating to apparently high remuneration to KMPs. A lot of the dissatisfaction, though, has been driven more broadly by companies failing to comply with societal norms, such as paying bonuses whilst keeping JobKeeper, or failing to appropriately link executive pay to the progress or lack thereof on climate. Where a first strike has already been received, companies should make sure they are appropriately explaining in their remuneration reports how they have dealt with the shareholders' concerns. Even where you have not received a first strike, this increased focus means it is more important than ever that your remuneration report clearly articulates your organization's remuneration strategy and outcomes for the year. It may be worthwhile spending some time this 30 June looking at your remuneration report with fresh eyes to ensure that it tells the appropriate story. Given that preparing a remuneration report can be a complex area, this week we released a new guide, Insights into Remuneration Reporting, which you may find helpful to help ensure you're complying with the relevant regulatory requirements. The publication can be found on our website, so please speak to your KPMG advisor if you're looking for a copy.
Thanks, Kim. We are now going to have a look through some of the key regulatory areas of focus as we approach June. Firstly, let's touch on ASIC's financial statement surveillance. Given the timing of our webinar, we don't yet have ASIC's 31 December 2020 surveillance results. These are expected to be released sometime during June. Taking a look at the 30 June 2020 reporting season, ASIC reviewed the financial reports of 170 entities and made inquiries of 27 entities on 58 matters. The chart on the slide shows the areas where inquiries were made. We see from the results that the highest percentage of inquiries related to impairment and other asset values. Impairment took back the top spot from revenue recognition. This shift was unsurprising given the significant uncertainty introduced by the COVID-19 pandemic, which many entities were facing for the first time during the 30 June 2020 reporting season. Another notable change saw ASIC raise several inquiries about the quality of an entity's OFR. Again, this was connected to COVID-19, with inquiries centering around the extent to which the OFR complemented the financial report and told the story of how the entity's business is impacted by the COVID-19 pandemic. On impairment and other asset values, ASIC looked into 19 matters. These were largely similar to the 31 December 2019 inquiries, though COVID-19 was notably an added challenge for organisations. To touch on a few, reasonableness of cash flows and assumptions having regard to matters such as historical cash flows, economic and market conditions or uncertainties due to COVID-19 conditions. How lessees adjusted their impairment testing to include right-of-use assets and appropriately adjusted the recoverable amount cash flows and discount rate. and disclosures. A number of organizations are still not making necessary disclosures of sensitivity analysis, key assumptions, and how uncertainties were addressed. And for fair values, the valuation techniques and inputs used. Given COVID-19, there is heightened focus on how organizations have addressed the potential uncertainties in their impairment modeling. Switching to the OFR, ASIC raised 8 inquiries. I'll highlight 2. In some cases, information on business strategies and prospects was not disclosed. It was acknowledged that the impact of the COVID-19 pandemic can present challenges in providing information about prospects. However, some organizations did not explain why this was not disclosed. Additionally, the unreasonable prejudice exemption from making disclosure of strategies and future prospects was used where this did not appear justified, and competitors in the same industry did not place similar reliance. Kim, is there anything which you would add from your experience with ASIC surveillance or inspections?
Just going back to the topic of impairment, I would say that given the sensitivity of recoverable amounts to some assumptions, organizations should make sure that they are clearly documenting their consideration for all reasonably available information at the time of preparing the financial statements and helping them to form their estimates. This sort of documentation should clearly reference external source information, and it will help support the use of certain assumptions both to your auditors and ASIC if required. This is particularly relevant when new information becomes available subsequent to period end, and the benefit of hindsight may make someone question the use of certain assumptions that you've taken.
Thanks, Kim. Moving away from ASIC's surveillance activities, ASIC's focus areas for 30 June 2021 are expected to be announced in June. Shown here are ASIC's areas of focus for the 31 December 2020 financial reports. We do not expect significant changes for this June, and as the impact of COVID-19 continues, ASIC's focus areas are complemented by ASIC's COVID-19 FAQs. ASIC's media release contains detailed guidance on the specific factors shown on the slide. The key messages include asking directors and preparers to put themselves in the shoes of investors and consider what information investors would want to know when preparing the financial report and OFR. For insights on how the ASX 200 present non-IFRS measures in the OFR and financial report, an area of ASIC focus, we recommend having a look at our publication, Non-IFRS Measures and Reshaping Financial Statements presentation available on our website. We also just wanted to mention that ASIC recently announced that it will extend the deadline for both listed and unlisted entities to lodge financial reports by 1 month for balance dates from 23rd of June to 7th of July 2021. Watch out for our reporting update for more details on this. I will now pass over to Oksana, who will talk to some Australia-focused reporting matters.
Thanks, Hayley. We have finally arrived at 30 June 2021, and it will be the last year that for-profit organizations that are required by legislation or their constitution to prepare accounts in accordance with accounting standards will be able to prepare special purpose financial statements. From years beginning 1st July 2021, such organizations will need to prepare either Tier 1 financial statement with full disclosures or the new simplified disclosures regime, which we would expect will be the case for the most entities. We have discussed this topic in details in our previous webinars, and you can find more information on this topic on our website, whose address is included at the bottom of this slide. But before you roll forward your special purpose accounts for the last time, it may be worth considering early adoption of the simplified disclosure at 30 June 2021, as ISB have provided an additional transitional relief for early adopters. In particular, if you early adopt, there is no need to restate comparative information, and for the notes where you have not previously provided information, you do not need to go back and disclose it for the comparative period. The counterside to this argument is that either way, you will be preparing all the relevant information for the 30 June 2021 year end. It is just a question of whether you want to prepare it now or in 12 months' time. If you are a non-for-profit and you want to better understand how the changes to reporting framework might impact your organization and sector, please refer to the not-for-profit webinar from 20 April 2021, a recording of which is available on our website. I will now hand back over to Kim to wrap up.
So this brings us near the end of our webinar today. And what you'll see on this next slide is key takeaways from today's webinar. In the interest of time, I will leave these takeaways for you to consider and we'll move on to responding to your questions.
So the first question that we would like to respond to is one around cloud computing and the application of the IFRIC agenda to this 30 June. So I'll respond to that one. Just a reminder, IFRIC agenda decisions do have the same force of guidance as an accounting standard. And I think about a year ago, the IFRIC chair did come out and say that IFRIC agenda decisions should be applied on a timely basis. And the expectation is that they will be applied, in the next reporting period after the agenda decision has been finalised. So in the slide that we presented, we said that the agenda decision was subject to ISB approval. That was approved last week, so that will be effective for 30 June. Having said that, we do acknowledge that some companies will have significant or have some practical challenges with applying that IFRIC agenda decision. And I think similar to the agenda decision that we had on lease terms, where there was also practical ability with applying it on a timely basis, there is a possibility that if you genuinely will not be able to get through your assessment, that you might be able to get to a position where you, in your conversations with your auditors, that you could wait until the December reporting period and make disclosures in your 30 June 21 accounts around the existence of this IFRIC agenda decision and its potential impact. But if you think you are going to be in that area, you should absolutely be having that conversation with your auditors, because I think their starting position will be that it should be applied this 30 June, and we do know that that is where the ASIC, our regulator, is. So that's a long-winded answer to that, but I thought I'd just kind of try and be thorough with that response. Hayley, there's also a question here for you on the amendment to the Fair Work Act, legislation that was issued in March. And the question was whether you were expecting to see a significant number of companies reversing provisions for leave entitlements for their casual employees. Would you be able to make some observations on that?
Yeah, sure. So I think it's going to depend on what the employment practices of the organisation are and whether their employment contracts will meet the new definition of casual, or if they don't meet the new definition of casual, whether they were paid casual loading and how clear it is what the casual loading was compensating for. I would, however, comment that we did keep an eye on how the ASX 100 responded to the Workpac versus Rosato ruling last year, and we actually did not see that many organisations recognise provisions last 30 June. So where entities disclosed that they may be affected by the permanent casual ruling, more entities disclosed contingent liabilities for possible leave obligations rather than recognised provisions. So as a result of that, it might be that we don't see that much being reversed in the profit or loss this 30 June.
Thanks for that, Hayley. Kristen, so maybe just going back to, the earlier part of our webinar, there's a question here about IBOR reform and the observation that you made around Australia is not currently impacted. Are we, we're not expecting any changes to the Australian rates in the future? You better make some observations on that.
So BBSW in Australia is not set in the same way that IBOR rates overseas are set, which is why it's not being caught up in the current reforms. We do know that there's been some increasing awareness of alternative rates in Australia, including the Australian Overnight Index Rate, or AONIA, which we know it has been used as a benchmark in at least one bond issuance. However, there's no regulatory intent at this stage to actually replace BBSW with any other rate. But obviously this always might change in the future. But at this stage, yeah, there's no expectation that Australia will follow suit.
Okay. Thanks for that, Kristen. And I do apologise. We did have a lot of content to cover in our webinar, and we haven't been able to get through all of your questions, but we do commit to responding to your questions separately following today, and we'll do that through your usual KPMG contact. So please just watch out for that, I guess an email or a phone call from them. And a reminder that next week you will be receiving an email containing a recording of this webinar and our slides, and I guess for ease of reference, you would have heard us refer to a number of our additional guidance and publications on the various topics that we have covered, and we'll actually include links to those various publications and additional guidance in that email that you will receive next week, so please watch out for that. Thank you so much for attending our webinar today. Before you leave the session, could I ask that you please complete the survey that we've just pushed on how you found today's webinar and what topics you're interested in for future webinars. We do use this information to, I guess, come up with topics and content that we, want you to find useful and interesting. Thank you for your attendance.